We've had a lot of artificial intelligence, especially the smaller AI stocks, have been breaking out lately. And billionaires are said to be buying ANET and selling Palantir. And I think it's because Palantir has gone up more. ANET has gone up well as well, but not quite as impressively as Palantir. Billionaires are selling Palantir stock and buying a stock split AI stock up 525% in 4 years. Certain billionaire-led hedge funds sold shares of Palantir and bought stock in Arista Networks, symbol ANET, during the third quarter. Palantir's artificial intelligence platform has supercharged its business, but the stock still looks absurdly expensive at its current valuation. Arista is the leader in high-speed Ethernet switches, which positions the company to benefit as businesses invest in artificial intelligence infrastructure. Palantir Technologies, PLTR, has been one of the hottest stocks on the market this year. However, Arista Networks ANET, a company that conducted a 4-for-1 stock split on December 4th, has been the better performer over the past 4 years. Palantir's shares jumped 190% during that period, while Arista shares soared 525%. The billionaire-led hedge funds below sold shares of Palantir and bought Arista stock in the third quarter. Cliff Asness Capital Management sold over 99,000 shares of Palantir, reducing its stake by 16%. The hedge fund added 248,000 shares of Arista, increasing its position by 46%. Israel Englanders Millennium Management sold 4.4 million shares of Palantir, reducing its stake by 90%. The hedge fund also bought over 23,000 shares of Arista, increasing its position by 5%. David Shaw's D.E. Shaw Investment Management sold 1.7 million shares of Palantir, reducing its stake by 35%. The hedge fund also added over 28,000 shares of Arista, increasing its possession by 612%. Palantir Technologies, the stock some billionaires sold in the third quarter. Palantir specializes in data analytics. It began building software for the U.S. intelligence community over 2 decades ago and has since expanded into the commercial sector. Palantir's core products, Gotham and Foundry, let customers turn complex information into actionable insights. For instance, semiconductor manufacturers can use Palantir's software to manage supply chains and improve production yields. Last year, the company expanded its portfolio with the launch of AIP, an artificial intelligence platform that integrates large language models into Gotham and Foundry. This enables clients to apply generative AI to their operations. For instance, a semiconductor manufacturer using Foundry for supply chain management could prompt the platform in natural language to suggest resolutions as problems arise. AIP has garnered praise from several industry experts and supercharged Palantir's business. Forrester research analysts, led by Mike Gualtieri, recently ranked AIP as the best AI platform on the market, and Palantir has reported an acceleration in sales growth for the last 5 quarters, driven by what CEO Alex Karp describes as unwavering demand for AIP. Unfortunately, Palantir has a valuation problem. Wall Street expects adjusted earnings to grow at 24% annually through 2026. The consensus estimate could be a bit low, given that AI platform spending will increase at 40% annually through 2028, according to IDC. Even so, Palantir currently trades at 200 times adjusted earnings, an absurd valuation even if earnings were projected to increase at 50% annually in the next few years. Investors who chase Palantir right here could wind up in trouble. The valuation will fall at some point, and there are only two ways that can happen. Either earnings grow much faster than anticipated, or the stock eventually suffers a correction. The most prudent choice for prospective investors is to avoid the stock right now, and current shareholders should consider trimming large positions. Arista Networks, the stock some billionaires bought in the third quarter. Arista specializes in networking solutions for enterprise and cloud data centers. The company complements its hardware, switches, and routers with adjacent software for network automation, monitoring, and security. Arista is the leader in high-speed verticals of the Ethernet switching market, 100 plus gigabyte, with more than twice as much market share as the closest contender, Cisco Systems. Arista says its two key innovations let it disrupt the market. First, it provides a single version of its extensible operating system, EOS, that runs across all its hardware, which simplifies network management. Second, it relies entirely on merchant silicon chips built by third parties rather than designing its own chips. That lets Arista focus research and development spending on software development and affords customers flexibility in selecting chips. Arista checked all the right boxes with its third quarter financial report. The company beat expectations, raised full-year guidance, and provided upbeat insight into 2025. Specifically, revenue increased 20% to $1.8 billion, and non-GAAP net income rose 31% to 60 cents per diluted share. Management now expects revenue to increase 22% in the fourth quarter, and the company anticipates 16% growth in 2025. Going forward, data centers will need to modernize their network infrastructure to keep up with advancements in artificial intelligence. Arista is ideally positioned to benefit from that trend, given its leadership in the 100-plus gigabyte market verticals. But Wall Street expects the company's adjusted earnings to increase at 14% annually through 2026, which makes the current valuation of 49 times adjusted earnings look expensive. Arista is a great company with compelling growth prospects, but the current price tag is a problem. I think this stock is best relegated to a watch list for the time being, and I say that as a current shareholder. I would feel more comfortable adding to my position in the event of a 20% pullback. That's what they always say when the stock goes up and when it's overvalued. And I have found it is such a mistake to get out of a stock too early. That's why I put the 4% trailing stop loss on all my stocks. That should catch the downdraft. You're usually ahead, especially when we've got a clear runway until January 21st. All we have ahead to worry about is inauguration risk. The VIX is in the 12s now. That signals a super bullish market. It's a big mistake to get out of these winners right now, I think. And looking at the chart of Palantir versus ANET, which is Arista Networks, you can see what they're talking about. I mean, ANET has made over 83% year to date. That's outrageous, of course, in that short of a period of time. And it's been a very good stock of mine. I also own Palantir, which has also been super wonderful, as it has made over 344% since the beginning of the year. So, yet are they overbought? Well, Palantir's relative strength is 79. Yeah, I would take that in this case, as there's high demand for it. But the thing with Palantir, it has this almost cult-like following that sees it as a very patriotic stock also, and they just love the stock. And the day traders I follow, they love this stock. And I think the cult following can't be underestimated, and there's no way to measure that. And I don't know when it's going to give out. That's why I put a trailing stop loss on it and let it go, because it's likely to cut back at some point, but who knows when. And so I'm letting the trailing stop loss cure that for me. Thanks for listening.